Welcome to FANG Friday. This is Ross Healy, Chairman of Strategic Analysis Corporation, and we are going to take a look at the FANG stocks, plus a couple of others today. And I'm going to do this from what I would call, I think, a completely different point of view. I'm going to give you a completely different look at our service. And I want to show you two or three valuable features in our service that we probably do not emphasize enough. So today I'm going to use the reconfigure feature in our chart service to show you the historic price-to-book range as well as the profitability of a company over time, because I want to answer the question, how does price respond to profitability? How does price respond to profitability? I will reference price to the book value rather than the usual way, which is to reference the book value to price. You will see how our technical breakpoints interact to changes in profitability over time and how you can use this knowledge, in particular at this time of market, to avoid potentially massive losses among your holdings. Let's start with Amazon, and once again we are simply referencing the book value to the price, and you can see the big swings in the book relative to the price, and those are pretty well correlated with the profitability, which is this dotted line here, over time. Of course, in this period in here, this was the period in which Amazon was basically buying market share, so they didn't make much money, but once they stopped doing that, then the profits have begun to really flow through. The same thing, I think, can be said for Facebook. Here's the early days when the company was building, the usual kind of catching your breath, and subsequent to that time, the profitability per dollar of equity had been moving up, although the stock valuation itself did not really do much more than get just short of its bubble price, with a sort of a fulcrum around its MSG that is 5.5 times book value. And note that I have all of those, the names that I have given to the breakpoints, and I have now got the precise price to book value there so that you can see what they are. Here's Alphabet, and what an interesting picture this is. For years and years and years, the profitability of Alphabet has been running around about the 17-18% range, and you can see what that means in terms of its fair market value potential and the price itself. Well, the stock price has pretty much revolved around that fair market value. When the stock price got as high as about 4.5 times book value, it got well over that price, and I knew that it was going to pull back. So we've been waiting for that pullback to occur. Netflix, wow, is this volatile or is this volatile? Here's the initial run, the setback, and look how big those setbacks can be, from 16 times book down to 3.5 times book. Again, a second run up to 42 times book, down to 3.5 times book as the earnings collapsed. This time around, the stock price has run up with the fair market value, but the earnings here, you see, they've sort of capped out, and with it, the profitability of the company, if losing those 2 or 3 major shows begins to have some impact on the profitability, then we may well look at another big decline in the price. Technically, the stock has not been acting well, and I am nervous about the outlook. Another hugely cyclical stock is Nvidia. And I think the one big thing to note is look at the profitability way back in 2000, look at the profitability today. It's about the same. Look at the peak valuation, look at the peak valuation. They peaked out at virtually exactly the same place. When those earnings and the profitability began to fall, however, look how far the stock price fell. 20 times book to 1.5 times book. Well, we've checked back halfway, anyway, from 20 to 7.5. It's going to be interesting to see what happens to earnings going forward. Apple, well, Apple has pretty much tracked its fair market value really throughout most of its history. It did on the iPhone, it did run up quite a bit above it, but it quickly fell back down to that level again and has been pretty much capped at its fair market value. As that's where it's trading at today, I can see no particular reason for holding this stock because I would be more nervous about the downside from this kind of level than any upside potential, which as you can see in the chart, you can't even see it. Here's Microsoft, and the same kind of a deal. Here's Bill Gates getting going and basically getting a lock on the PC market, but that eroded away, and with it the profitability. Well, here's the first major refresh with the Windows 7, and look what happened. The profitability went right back up to its old highs, but that refresh died away as well, and with it so did the valuation and the price of the stock. The last refresh has been Windows 10, but look, the profitability is nowhere near the old highs. And that means that the stock, which has got back up to its pretty much to its old high, at least the old high on the Windows 7 refresh, is fundamentally running out of gas. I would be very nervous about this company. The last company is a kind of a special treat. This is McDonald's, and we're showing here the fair market value of the company, and the company stuck pretty much to that throughout most of its time in that last 35 years. In 2000, it got up to about a 100% premium to its fair market value, crashed to it, and then went to a 50% discount to it. Well, here is the stock buyback, and of course, the profitability of the company has absolutely soared. However, what's happened in the last little while is that nothing much has happened. The stock price has continued to go on, rise above its 54 times price to book, up to the current 108 times. But the profitability and the fair market value have not kept pace. They're about 60% below that. Well, that's what happened here too. And look how far that it ultimately went. I would be very, very cautious about owning this stock at the present time, as I fear the downside risk is massive. I hope you have enjoyed our little journey into the inner workings of the market. I've done it to show you that mostly the market is not insane and actually makes some sense. However, stocks can reach absurd valuations, and often you can actually see the fundamentals start to fade under your feet with SVA. As those are the stocks that will eventually crush your portfolio, they are the ones to avoid. Anyway, this is Ross Healy, Chairman of Strategic Analysis Corporation and Portfolio Management at McNichol & Associates, reminding you that nothing, including investing, is difficult if you have the right tools. See you next week.